In this video, you are going to learn how the two-candle liquidity grab reversal model works and how professional traders use this framework to identify potential market reversals around key higher time frame liquidity levels. We will break down how to recognize valid liquidity grabs around major swing highs and swing lows, how to identify high probability reversal areas using higher time frame bias, fair value gaps, CISD, current trend range, premium and discount zones, and how to use lower time frame confirmations to build more structured and efficient trade executions. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now let's begin with the bullish side of the two-candle liquidity grab reversal model and how this concept can be used to identify potential continuation after a liquidity sweep to the downside. In a bullish scenario, the higher time frame market structure is already trending upward. After creating an impulsive move to the upside, price may begin retracing lower into a key higher time frame point of interest, such as a bullish fair value gap, demand zone, or bullish order block. As the market trades back into that area, we begin watching for signs that the retracement may be ending and that bullish continuation could soon resume. The setup forms when the second candle sweeps below the first candle's low, but fails to continue lower, and instead closes back above the previous candle's range. This suggests that bearish continuation may be weakening and that the market could now be preparing for bullish continuation aligned with the higher time frame trend. This is what creates the two-candle liquidity grab reversal. The first candle establishes the reference low, while the second candle trades below that low to grab liquidity before reversing and closing back above it. This indicates that the market may have engineered the move below the lows only to fill orders before continuing higher. Once this bullish reversal is confirmed, we can begin shifting down to lower time frames to look for execution models and confirmations for long positions, such as a bullish CISD, a change of character, or any lower time frame confirmation supporting bullish continuation from the higher time frame point of interest. However, if the second candle closes below the first candle's low and also closes below the higher time frame point of interest, then the setup no longer represents a bullish reversal. Instead, this becomes a continuation scenario, suggesting that price may continue expanding lower. In this situation, we should avoid looking for bullish or long setups, because the market is showing acceptance below the higher time frame level, rather than rejection, signaling potential bearish continuation instead. Another important situation can occur when the daily chart is already trending bearish and price continues moving lower into a major swing low from an even higher time frame, such as the weekly or monthly chart. In this case, that higher time frame swing low becomes a major external liquidity level and a strong area where the market may potentially reverse back to the upside. If price trades below that higher time frame swing low, grabs the liquidity resting beneath the lows, but then closes back above the level on the daily candle, this can also qualify as a bullish two-candle liquidity grab reversal. This is important because even though the daily trend may still be bearish, the market is now reacting from a much larger higher time frame point of interest, increasing the probability of a bullish reversal, or at least a significant retracement higher. However, if price fails to create a valid bullish two-candle liquidity grab reversal and instead continues showing bearish continuation below the higher time frame swing low, then we should avoid looking for bullish or long setups. In this situation, the market is showing acceptance below the higher time frame level, rather than rejection, suggesting that bearish continuation may still remain in control. Now let's look at the bearish side of the two-candle liquidity grab reversal model, and how these concepts can help us identify potential continuation after a temporary bullish retracement. In a bearish scenario, the higher time frame market structure is already moving lower. After creating a strong bearish expansion, price may begin retracing upward into a key higher time frame area, such as a bearish fair value gap, supply zone, or bearish order block. As price moves back into that region, we begin watching for signs that the bullish retracement may be losing strength and that the primary bearish trend could soon resume. The setup develops when the second candle trades above the first candle's high to sweep liquidity resting above the highs, but then fails to continue higher and instead closes back inside the previous candle's range. This suggests that the bullish retracement may be weakening and that the market could now be preparing to continue lower in alignment with the higher timeframe bearish trend. This is what creates the bearish two-candle liquidity grab reversal. The first candle establishes the reference high, while the second candle sweeps above that high to trigger liquidity before reversing and closing back below it. This often indicates that the move above the highs was engineered only to fill orders before bearish continuation resumes. Once this bearish reversal is confirmed, we can begin dropping down into lower time frames to look for execution models and confirmations for short positions, such as a bearish CISD, a change of character, or any lower time frame confirmation aligned with the higher time frame bearish narrative. However, if the second candle closes above the first candle's high and also closes above the higher time frame point of interest, then the setup no longer represents a bearish reversal. Instead, this becomes a continuation scenario, suggesting that price may continue expanding higher. In this situation, we should avoid looking for bearish or short setups because the market is showing acceptance above the higher time frame level rather than rejection, signaling potential bullish continuation instead. Another important situation can occur when the daily chart is already trending bullish and price continues moving higher into a major swing high from an even higher time frame, such as the weekly or monthly chart. In this case, that higher time frame swing high becomes a major external liquidity level and a strong area where the market may potentially reverse back to the downside. If price trades above that higher time frame swing high, grabs the liquidity resting above the highs, but then closes back below the level on the daily candle, this can also qualify as a bearish two-candle liquidity grab reversal. This is important because even though the daily trend may still be bullish, the market is now reacting from a much larger higher time frame point of interest, increasing the probability of a bearish reversal or at least a significant retracement lower. However, if price fails to create a valid bearish two-candle liquidity grab reversal and instead continues showing bullish continuation above the higher time frame swing high, then we should avoid looking for bearish or short setups. In this situation, the market is showing acceptance above the higher time frame level rather than rejection, suggesting that bullish continuation may still remain in control. Now let's move into the chart examples and see how to identify a two-candle liquidity grab reversal directly on the daily chart. The best way to practice this concept is by first locating major swing points where the market clearly changed direction. In this example, we are also going to mark a major monthly swing high, which will act as our higher time frame point of interest and external liquidity level. Now that the swing points and higher time frame point of interest have been marked on the chart, we can begin identifying where valid two-candle liquidity grab reversals are forming within the market structure. You can see that some of these swing points form clear liquidity grab reversals, while others simply react at the level without creating a valid setup. This is important because not every swing point or reaction creates a tradable opportunity. Now that we have visually identified the major swing points and the valid two-candle liquidity grab reversals forming around those areas, we can begin simplifying the chart and focusing only on the most important setups. At this stage, we no longer need all the previous annotations, because the goal now is to isolate the highest probability areas where the market provided a clear liquidity grab reversal aligned with the higher time frame narrative. The first point is the beginning of the bullish leg on the daily chart. The second point is the origin of the bearish order block that created the fair value gap and ultimately led into the final point, which is the setup we are currently preparing to trade, the two-candle liquidity grab reversal. Notice that price traded above the first candle's high, but then closed back below it, creating the two-candle liquidity grab reversal. At the same time, price also traded above the major higher time frame swing point on the monthly chart before reversing back below it. This creates a strong confluence of liquidity and higher timeframe rejection, making this a high probability area to look for potential bearish continuation. It is also important to identify the daily trading range and mark the 50% retracement level, especially when it aligns with the fair value gap. I personally like to keep that 50% level marked on the higher time frame chart because it often acts as a major reaction area and can become an important target for potential short positions. Now that we have identified the higher time frame setup, the next step is to drop down into the 60-minute chart to begin looking for lower time frame confirmations and execution opportunities for entry. On the 60-minute chart, we can identify that price has already created a CISD, and this occurred before the daily candle fully closed. This is very important because the two-candle liquidity grab reversal on the higher time frame is only fully confirmed after the daily candle closes. So, while this CISD becomes an important area of attention, we should avoid entering the trade immediately because price has already delivered a significant portion of the bearish expansion on the 60-minute chart, making the entry less efficient from a risk-to-reward perspective. Instead, the ideal approach is to patiently wait for a retracement before looking for execution. This is where marking the current trend range on the 60-minute chart becomes important, because it helps us identify the premium and discount zones and anticipate a retracement back into the CISD area, which also aligns closely with the 50% retracement level. This creates a much more optimized and efficient location for entry. From there, we can place the entry around the 50% retracement, with the stop loss positioned above the most recent swing high. The first target at 1-to-1 naturally aligns with the most recent low on the 60-minute chart, while the 1-to-2.5 target aligns closely with the opening of the daily fair value gap and slightly above the 50% retracement of the higher time frame range, creating a strong area for potential profit taking. As we can see, price eventually retraces back into the 50% area, triggers the entry, and then delivers a strong bearish expansion, ultimately reaching the 1-to-2.5 target. The goal of the two-candle liquidity grab reversal is not simply to identify a candle pattern, but to understand how the market engineers liquidity around key higher time frame levels before continuing in the true underlying direction. By combining higher time frame bias, liquidity concepts, and lower time frame confirmations, we can build more structured, precise, and higher probability trade executions instead of reacting emotionally to random market movements. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.